Hey, it's Lewis here and welcome back to the channel, and in today's video we're going to be going through Coloplast stock. We'll be using TIKR terminal to go through the financials, and then we'll put these numbers into my analysis checklist to ultimately decide if this business is of good of quality for me to be interested in. We will then put the numbers into my DCF and we will come to a fair value of their stock. Let's get straight into it. So who are Coloplast? So Coloplast is a Danish multinational company that develops, manufactures and markets medical devices and services relating to ostomy, urology, continence and wound care. So the company itself was founded in 1957, and the family that founded the company still own like 20% of the company, which is pretty cool. They employ 12,000 people worldwide, operates across the world, sales activities in 53 countries, headquarters in Denmark. And yeah, they are a really big company, you know, like it's probably one of the biggest companies you've never heard of. And they're really important for people who use like ostomy bags and stuff, and people who don't have colons, for all sorts of different reasons. So they're a really important company in terms of healthcare. The company itself is publicly traded, of course, hence I'm doing the video, and traded on the Nasdaq Copenhagen under the ticker symbol COLO-B. Now let's have a look at the sales for Coloplast, and we'll start with the sales per business. Chronic care in 2021 made up 76%, wound and skin care made up 13%, and then interventional urology made up 11%. Sales per region, so European markets make up 30%, United States 19%, emerging markets 17%, United Kingdom 15%, France, which is on its own here, 12%, Denmark like 1%, and then the rest makes up 6%. Now let's have a look at the financials for Coloplast using TIKR terminal, and we will start with the income statement. So over the past 5 or 6 years, revenue was just increased, low single digits, low to mid single digits, really. Can't really say much more than that, which is a good thing for increasing the revenue, but ever so slightly, not much. Right, okay, so we'll have a look at the net income now. The next figure I'd like to look at, and that's going up slightly as well. Lovely stuff. Pretty simple. Shares outstanding, you want these to go down over time because you want them to buy back shares, and it means as investors you want a bigger piece of the pie. Ever so slightly going up. Can you really call this share dilution? Because it's barely by much. Technically it is, but not much going on here at all. There's not many shares being issued. Balance sheet time, so cash and equivalents just stays quite similar. It's down from like 5-6 years ago, but since then it's remained at that 600, 500, 600, 700 mark. Not changed that much. Right, long-term debt. So there's no long-term debt. Wow, this makes me very happy as someone analysing a company when there's no long-term debt. Alright, okay, there's current portion of long-term debt, but I don't class that as long-term debt. Long-term debt is when it's due in over a year. Technically, there's none based on this, so that's a good sign. Love that. Return earnings going up over time. Easy metric to be like, that's a good thing. Cash flow statement. So cash flow operations minus capex is free cash flow. So the most important figure when valuing a company. Yep, so the cash from operations is slowly going up over time, and the capex, yeah, it's going up a little bit, but the cash from operations is going up quicker, so free cash flow is going up, so which is a win-win, and we'll see that from my analysis in a minute. Repurchasing shares, we're not really doing that much, as we've seen, and we're probably just issuing shares to employees as reward, and then buying back what they've issued. That's kind of what we're doing. It's what a lot of companies do. If they don't have an aggressive share buyback program. Dividends paid, so something interesting here. The amount of dividends paid has increased massively over the past 5-6 years. It's more than doubled since 2016, the amount of dividends have paid. So that's a really good sign. Special dividends as well. If a company's paying special dividends, that's a good sign. It means that they do really care about the shareholders. I mean, you only pay a special dividend if you don't have any use of the cash at all, hence a special dividend. but it's a nice thing as a shareholder. Haven't had it past 2. COVID, of course, no special dividends because of COVID, keeping the cash in to help the business when it needs it most, which is totally fair. Can't knock them. Be cool to see if they could get some more special dividends out there in the future. Return on capital wise, oh my word, look at that. I know it's gone down a little bit, but that is high. That is extremely high. You're talking like in the 60s, I don't know, 55 for 21, but wow, that is insane. Return on capital. I'm just gobsmacked really by that. There's not many businesses which can do that, and this might be a reason why the valuation is so steep at the minute. We will get into that, but because the return on capital is ridiculously high, it's awesome stuff. Gross profit margin, high margins on this business, and also net margins as well, stable over time, and also a very nice amount. Current ratio way above 1 in the past as well, so no complaints. Cash conversion cycle not below 60. Take on the chin now, it's a good quality business. Debt to capital solid at 24%. It's been going up a little bit, so you don't want it to go up much more, but yeah, we'll take it. But yeah, no, if you want to use TIKR yourself, I've got a link in the description below. Click it, use TIKR, have a good play with the financials of companies you're interested in, and you'll learn a lot from this platform. I'm absolutely loving it myself, and yeah, just go ahead and have some fun. If you are enjoying today's video, then why don't you book in a one-to-one coaching session with myself? In these sessions, you will learn how to analyse a company using fundamental analysis. As well as this, you will learn how to value a company using a DCF model. Value investing is the art of buying stocks which trade at a significant discount to intrinsic value. Value investors like myself achieve this by looking for companies on cheap valuation metrics, typically lower multiples of their profits, assets, and cash flow as well, for reasons which are not justified over the long term. Billionaire value investors such as Warren Buffett, Charlie Munger, and Joel Greenblatt have all used these timeless concepts to beat the market over the long term. No financial advice will be given on these calls, financial statement analysis and business valuation, education only. I will see you there. Now on to Genuine Impact, and Coloplast is probably the first company I've used which isn't on the Genuine Impact platform. Coloplast is a Danish company and it's a little bit obscure, so it's not on the Genuine Impact platform. But if you'd like to use Genuine Impact, then head over to the description, go into the link in the description, and you can, use Genuine Impact through my link, and you can research stocks in 2 minutes using their platform. On most of my stock analysis videos, I do go through the value and quality metrics, and I'll have a quick look at the growth as well. But head over to Genuine Impact, download the app now. Great platform for screening stocks especially, and you can have a quick look what's looking really cheap and what's good quality as well. So head over to Genuine Impact. Now let's have a look at my analysis checklist for Coloplast, and we'll start with my first pillar, profitable, high returns on capital using low leverage. So as we've seen from the financial analysis I've already done via TIKR Terminal, high returns on capital, 62% 5-year average, one of the highest I've analysed I believe, and this is the reason I'm interested in these guys. High returns on capital businesses over time outperform worse return on capital businesses. It's a fact. And it's something Charlie Munger's a big proponent of, and if you can buy high return on capital stocks cheap, absolutely laughing. Gross profit margin anyway, 68%, solid. Net profit margin, 23%, really good stuff, and free cash flow margin 16%. They aren't too far apart. Maybe not too worried about that, to be fair. Current ratio above 1, love that. Cash conversion cycle we spoke about, it's not above it, but we can deal with it. Debt to capital ratio 24%, so not much debt. So the capital structure of the business is on 24% of it is debt, so that's lovely. Proven ability to grow. Business has been proven to grow because all of the 3 metrics I look at: revenue growth, net income growth, retained earnings growth, and free cash flow growth. It's all there, lovely stuff. Capital allocation wise, I've issued a bit of debt. You don't want to issue loads of debt, but I guess it is manageable. It's all in perspective really. So that metric's red because we've issued some debt, but the debt to capital ratio is 24%. So it's not a big deal, but it's still red. You don't want it to go way higher, above 50%. You don't want that, and hopefully just they're not going to do that. Something to monitor if you run this company. Decreasing share count, issued one, so a bit harsh, but it is what it is. Dividend growth is there, which is awesome. Good acquisitions, don't really make much acquisitions, so it may be a bit harsh, but it is what it is. 80% quality score, which is class, really good stuff. Right, so buy at a fair price. Don't know why the PE ratio is not pulling through. Something wrong with Google Finance there. We can deal with it. But price of free cash flow is 39, so that is very high, especially for a company which doesn't grow a lot. DCF valuation, so this is in Danish money. I don't know what the currency is called. Is it krone or something like that? 297. Current share price is 851. 65% decrease to get to my fair value. And if you look at my DCF, I've taken these from marketstream.com, and yeah, what can I say? It's just looking very pricey. It's looking like one of those stocks which, because it's so high quality, the market thinks it's worth an infinite amount, and for a 10% return, it needs to drop 65%. It's simple as that. It's just the numbers are speaking here. I think this is a great company, the financials are showing that, but I'm not overpaying for it. Simple as that. We'll see if this company even gets to 297, and if it doesn't, I'm just going to stay away, because if it doesn't meet my analysis, I'm not going for it. Simple as that. The numbers don't lie, and you've got to trust the numbers. Simple as that. So there we have it. That was my full stock analysis for Coloplast. And if you enjoyed today's video, then please subscribe to the channel. Thank you very much for watching. I will see you next time. Thank you for watching. As always, it would be amazing if you could like, comment and subscribe to the channel if you enjoyed this video. I will see you in the next one. However, you can check out some of these videos.